The problem is that rents were appreciating, interest rates were appreciating greater, so the cash flow couldn't catch up to the interest rates. So the deal started not to pencil so quickly. So people start to sit on the sideline and say, you know what, I need to see some stability on the interest rates. That's one side of it.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest, Marcia Kaufman. Marcia is an expert in lending, and she's going to lay that out today, the lending landscape, and 30 years plus experience. So this is what most of you, or many of you, have been asking for. She's the CEO of Bayport Funding. Has grown the firm by 40% since she's been there. Closed over $250 million across 220 transactions last year, listed in Housing Wire, Connect, Commercial Real Estate, and other publications as a leading woman of influence and top performing lender in the tri-state area. So 3+ decades of experience in the mortgage banking and real estate industry. So ultra experienced leader here in this space. And Marcia dives into that and shows that today. No doubt about it. You're going to hear her today and tomorrow. We're going to dive into the lending landscape, but also what's caused the 40% growth. And you're going to hear so much experience come out and just leadership, her ability to lead and what she has done to grow has been incredible there at Bayport. Marcia, welcome to the show. Honored to have you on. I love having guests on who have been in the business a long time and with your level of expertise and experience, especially talking about a topic that's on everybody in this industry anyway. It's high on their list of wanting to know more about and having lots of questions. So thank you for being on the show.
It's great to be here, Whitney, and thank you for having me.
Yeah, honored. We're honored to have you. Well, I want to jump right in. You are an expert, no doubt about it, in lending, right? And been in this business a long time. And you even mentioned, this is one of your superpowers, is the lending landscape. And I think that's what everybody wants to hear anyway. So I want to just jump right in. Why don't you paint that picture for us a little bit right now on the current, landscape around lending and some things that we should know as buyers and let's get started there.
Well, an expert, I appreciate that, vote of confidence. I've been in lending for over 30 years, really in the commercial sector for the past 10 years. And when the Fed started their interest rate hike campaign and interest rates started to soar, people started to panic. For me, it's a market. I started lending when interest rates were 18%. So when rates are at 7%, it seems like a really, good environment. However, as you know, when everybody enjoyed 2 to 3% interest rates over the past couple of years, they lost sight of what a very stable, normal lending environment is.
Yeah, that to think about 18. I always remember the story my in-laws talk about when they bought their first house, and I think they assumed the debt because I think it was 17 or 18%, and they were thankful to get it, or 16, 17, something like that.
Correct. So right now, with the Fed interest rate and the 10, commercial loans are normally tied to a 10-year bond. And when the bond started to inch up on the yield, interest rates rose pretty quickly. The difference in this market compared to other types of the cycle where interest rates are up and down is this was a pretty quick rise. They went up very quickly. Interest rates normally go up very quickly and come down very slow, but this was a pretty rapid acceleration, and it caused a pause when people started looking for opportunities and to see if they were worthwhile with this current interest rate environment.
Yeah, walk us through that a little bit. Maybe even the repercussions of them going up so fast that maybe like we haven't seen that in the past.
So the repercussions are when investors or developers are looking for a multifamily opportunity, they'll take a look at it from a cash flow economics perspective, including debt yield and cap rate. And one of the key factors in analyzing a transaction is the current interest rate. So when interest rates are very stable, it's pretty relatively easy to analyze that the deal makes sense to invest in. We've seen an appreciating real estate market in the last 10 years, like we haven't in a very long cycle. Normally, there's always a bell curve. It comes up every 10, comes down. There's that curve. This was a very long time on the curve. So people are buying into opportunities and appreciation. As soon as interest rates start to increase, they stop buying into an appreciating real estate market and into a more normalized market. And what does that all mean in basic language? So in basic language, it means that, you're looking to acquire a multifamily property, interest rates are 2 and 3%, rents are rising rapidly nationally, rents have increased rapidly. So when you acquire property, you acquire it, you'll renovate a couple of the apartments so that you can increase your rents, and you'll buy that asset based on appreciating rents after you renovate those properties and re-rent them. The problem is rents were appreciating, interest rates were appreciating greater, so the cash flow couldn't catch up to the interest rates. So the deal started not to pencil so quickly. So people start to sit on the sideline and say, you know what, I need to see some stability on the interest rates. That's one side of it. The other side of the concern was, okay, usually on commercial loans for multifamily, they're term loans. They're 3, 5, 7, 10-year terms, and then they mature, and then you have to refinance. Well, if you acquired that property when interest rates were between 3 and 4%, and now you have to refinance around 6.5 to 7%, can you refinance with the current loan balance without bringing equity to the table? Will the rents support, with the rents rising, will they support the current interest rate environment? So there was a lot of concern in the market. And I think the fear has really stabilized. The rents have really been able to keep pace with the increased interest rates, and we're not seeing that many people on refinances having that big a problem yet. I don't know what the future brings as all these loans start to mature, but right now we haven't seen, the people, there was major concern in the market. I think that has softened quite a bit, it has tempered.
Is that a surprise maybe that you haven't seen as many issues as maybe expected, or maybe they weren't expected?
Is it a surprise? I'm not really sure. I'm not sure, have we not seen a surprise or have we not seen a surprise yet?
Yeah.
It's a beginning. As I said, we're seeing the 10-year bond start to come down a little bit and interest rates come back down. I'm sure that's causing a lot of ease of the concern. So it all also depends on how did that sponsor buy that property? Did he buy it? Did he cash out and take all the equity out? Did the sponsor keep low leverage so that so the rents really, kept pace with the current interest rates? They didn't take all their cash out. There's a lot of different variables when we're analyzing what will happen, and what will happen.
Who are, or I guess, what are the situations now that you see that are the operators that are in the best seat, right? Or are they prepared for this well? What's the difference in them and maybe the ones that, like you talked about, maybe their rents won't support, a refi?
So the key factor, I think, is, was the sponsor really experienced? Did they have a track record? Did they understand the asset class they were buying in? Did they not seek really high leverage when financing a deal? You saw a lot of newcomers come into the real estate multifamily market in the last number of years because there was so much opportunity. Everyone thought it's so quick, so easy. Oh, let me buy a property, multifamily, whether they were using their own equity or they were syndicating a deal, right? And we'll just, we'll buy them, we'll get the rents up, we'll refinance, return all the, give great returns back to our investors. And it was wild for a while, right? Well, now it's not that quick. It takes a little longer to perfect their business plan. They may not be returning those type of returns so quickly right now. Investors may have to stay in their deals a little bit longer, which is truly what a multifamily deal should be. It's not a fix and flip deal. It's a long-term play. So, these are all things that I think we're seeing. But a very experienced sponsor who looked at multifamily opportunity has that track record and that experience, just like I do. I've been through many cycles of real estate. So I look at lending from a aggressive conservative perspective. We understand that prices could come down, rents could come down, interest rates could come up. So we don't look to lever people very high. As a bridge lender, we'll be a little higher leverage because we're lending to the value added and how they can exit our loan. But we also take into consideration, as the market starts to change, what factors did we have to consider? So let me expand on that just a little bit. So when the Fed started their interest rate campaign, Bayport is a bridge lender. We'll take a sponsor who's looking to buy a multifamily building. will identify an asset and might need short-term debt to add value by renovating the apartments, raise the rents, and then they'll exit to a permanent loan from either a bank or an agency loan or a CRE loan or insurance fund or something of that nature. So when the Fed started raising rates about 18 months ago to 14 months ago, I told my chief credit officer to start adding 200 basis points to interest rates a while ago. And my office was in an uproar. My originators were like, our deals won't pencil, we won't capture deals. And I said, the best deal we do is the deal we don't do, right? And we're not, right? And we're not doing an investor a favor by putting them into a deal they can't get out of. We have responsibility. So we were very proactive in really modeling to a larger spread. And we also, we're the typical debt service coverage ratio, you look at 1.25. I told my staff, model it 200 basis points wider, do 135, just add some cushion, because we don't know how long the Fed will start this campaign, how long rates will stay high. And we want to make sure that the borrowers can exit our bridge to a permanent loan. Long story short, it was the right thing to do. As the Fed slowed their campaign, we eased up on that 200 basis points to 150, 100. Now we still are about 50 basis points above the current spreads, and we're back down more to 125 because we're seeing it's covering. And it actually worked out very well for us as a lender. We're a balance sheet lender, it's our own money. And it worked out very well for our investors, or our sponsors rather, who went out and identified opportunities that they bought a good opportunity.
Yeah. Wow. No, I appreciate you diving in there. I think it's hard oftentimes to keep up with what's happening or what the Federal Reserve's doing and what that means for us. And yeah, I've heard more and more talk about the caps that are coming due and whatnot, and people can't afford them, and you briefly talked about, you can't afford the refi or whatever, but there's many issues on the debt side. And one thing I wanted to mention that you said even earlier, you talked about sponsors that have the experience, typically will have the lower leverage as well. And on, different people I've interviewed, even recently, as we're talking about risk, and people that have been in the business like yourself, 30, 40 years, one of the biggest things they say is low leverage. And so I just keeps hitting me in the face, and I'm glad it is, right? As an operator myself. And so, but it's tempting, right? When things are just going amazing, or how much, how high a leverage can we put on something, right? And that's, you're not thinking long-term, right? You're not thinking about the potential downside in that moment.
Correct. And as a lender, we're competing for deals, for originating deals out there. And we're sticking to our credit guidelines, our underwriting guidelines. And we have long-term borrowers that have been with us for many, many years. And we'll hear many times that the guy, the lender down the road is going to offer more leverage. And for a moment, you take pause. Are they smarter than we are? Right? Are we willing to lose a borrower to a lender who's a lot more aggressive, or much given more leverage, or may underwrite to a lower debt service coverage ratio, or lower cap rates? And as a lender, you really have to you say, what do we do here? It's very hard at times when you're trying to build volume as a lender to stick to those strong principles. But if you don't stick to those principles, you're not going to be in business to talk about it. But as you know, or as everybody knows, there's been a lot of liquidity in the market over the past 7 years. Everybody, Wall Street's come in very heavily, insurance companies, the market's been very liquid, and the deal flow has been very strong. And in order to compete for deal flow, it's a couple of things: either lower interest rates, higher leverage, more flexibility on sponsor experience, all the things of the bells and whistles that create, should we be doing those deals? Ding, 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 ding. And yet we have to do business. I have, partners, a board that I report to. They're always discussing how's volume, how's origination, how's performance, how's our asset under management performing. And you got to balance that as operating a company.
No doubt about it. And I want to get to some of that in a bit, maybe in the next segment, just so the listeners know just the operation side of a company and how you have grown, 40%, I think, the business since you've been there. So I'm wanting to get into that. But before we do, maybe it's a good time for you to speak to, say, private, lending versus, say, larger institutions, and maybe some of the benefits, of that. I know many operators, listen to the show and may have used both, but maybe it's a good time for you to elaborate a little bit.
Great. So when the Fed started their interest rate hike, and we saw a couple of banks had some difficulty. I'm not going to get into those names. We all understand who they are. And banks in general started to have pencils down on commercial lending. They were taking a pause. Either they had to increase their deposits, or for whatever reason, they took a pause or were slowing down. Maybe they want to see how their assets under management were performing. We're an alternative lender. We're a private lender. And we have liquidity. We're here to lend money. So we're here to support borrowers and sponsors in their real estate opportunities. So private lenders, alternative lenders like Bayport, are doing very, very well. People may say we're a little more expensive. It's not really the case, especially as interest rates have risen. But we have seen a big uptick in inquiries and business with the market the way it is. The flip side of that, we've also turned away more loans than we've actually done, because some of those loans are refinances of loans that are either not just a maturity default, might have an event default. So we've been very careful about the loans that we are putting on our books, but we are there to support the sponsors with their good opportunities and their good loans. We're also there to support the sponsors who have maturity defaults, but they just couldn't get their deal done on time. So they perform very well at their current lenders. They might be mid-construction or mid-renovation. They need a little more time. Maybe they had building department delays or supply chain issue delays, and they just need a bit more time to complete their project. We've seen a big uptick in those type of loans come across our desk, and we've actually originated quite a number of those. That's been very good for us from a business perspective during these times.
Yeah. Yeah. It's such a relationship business, right?
Very
And
much so.
I love the, having the expertise of our lender to underwrite our deals, right? And give feedback. I love that. I love more eyes on that, and experienced, teams like yourself who have been doing this even, a lot longer than we have as well. So when they push back on something, it sharpens our knife, right? It sharpens our pencil, I should say. And so we get better, at underwriting. And I bet many of those deals that you didn't do, those operators may not have done it, but they're probably thanking you now. Right. They're thinking, man, they did me a favor by turning them away. So.
Right. And you brought up a very important point. There's no substitute for sponsor experience. There is none. We meet and speak to every sponsor that we lend money to. People think that's archaic, but it's not. We want to look at them in the eye. We want them to express verbally what their business plan is, talk about their experience. There's no substitute for that, getting to know somebody. Either it's done in person via Zoom, or we'll go, if it's out of our home geographic, we'll get on a plane or a train and go visit them, look at their project. We want to know where we're deploying our money and who we're deploying it to. And I would think equally important to a sponsor, as if we're going to a private lender or alternative lender, you want to know who you're borrowing money from. Do they have the capacity to deploy? A sponsor doesn't want to take down a loan and have construction or rehab money and not understand how that draw process money is deployed to them and how that affects their loan and their timeline. So, it's very important for that sponsor lender relationship, getting to know them, meeting them in person. It's a very mutual relationship.
Yeah, we've created a relationship with a lender that's good. I'm friends with the owner and stuff, and over time, right? And as they've got to know us, we had not done a deal with them yet, but we had another lender back out 2 weeks before closing, and they had backed out almost 500 loans. At this time, it wasn't anything just about us, and so it was a
Right.
massive ordeal, right? But this relationship, of this new lender came in and closed, within 2 weeks for us. So, but it was a relationship that we had built over, quite a long time, and so I can't speak enough about what you just said, just the relationship, meeting, and and just doing some life together, right, to get to know each other, right,
Sure.
before you're in a crunch situation like that. Then you're calling Marcia saying you're trying to figure that out, and you only have 2 weeks. Well,
But Whitney, to that point also, that's the difference with an alternative lender, is that timeline as opposed to going to a traditional bank. If you were in that bind and you came to an alternative lender, private lender like a Bayport, and you said, I have to close, I have a time of the essence, I need to close in 2 weeks, no problem. As long as we have that appraisal and title and we can really get your information in, that is a tremendous asset that we lend to our sponsor, that timeliness of being able to close quickly.
yeah,
It's a story we hear all the time.
I bet it is. It has to be. What about, speak to the Federal Reserve a little bit and the activities, what they do, right? How that affects multifamily and maybe your expectation, over the next 6, 8, 12 months.
Well, everybody always asks me, what do I think rates are going to do? I don't know. Rates are going to go up. They're going to come down. My crystal ball doesn't work on Tuesdays or Wednesdays. Catch me maybe on a Friday. But, the Federal Reserve, there's a campaign because they have to control the inflation. We're seeing some very good indicators. I think the employment numbers came out today. All those, high unemployment is good for interest rates, good for the economy. I think that we're going to see, I don't know where they're going. I believe that we should see softening, hopefully within, I would say 18 months or so. Some people say they're going to start to see the softening, already. You ask 3 people the same question, you're going to get 4 different answers, right? But the Fed had to raise rates. Did they do it too aggressively? Inflation was out of control. Real estate prices, appreciation were out of control. Rents were out of control. There was a need. This is not the first time that we've seen this. As rates go up, values come down, things come back in line. Although in some parts of the country, we haven't really seen, home prices come down or values come down or rents come down. That has to do largely also because we have a housing supply shortage in the United States, and that's a big problem. So geographically, depending on where we're lending or where people are borrowing, it depends on where the geographic. On the East Coast, housing supply is tight. If we just talk besides multifamily, on the 1 to 4 family side, there's a housing shortage, right? A home goes on the market, it goes right away. So we haven't seen home prices come down really aggressively. In more densely populated condo, areas, urban areas, have we seen those type of prices come down? Yes. In the multifamily sector, have we seen rents really top out? I think they're topping out, but we're still seeing slight appreciation, not the way that it was before. Then you have geographic areas or government situations where governmental controls, where you might have rent stabilization or rent control, and those lead to a whole bunch of other issues, right? In the New York area in particular, they did away with the 421A. So that's been a problem where sponsors or developers would come in and build a new multifamily with an affordable factor because they had this 421A tax abatement. New York's done away with that. So it has been a real incentive for sponsors to come in and build new multifamily because there's no tax abatement and the numbers don't make sense. So it depends on where the geographic area is, and and that has a lot of effect on it as well. There's not a lot of incentives.
Yeah. Where do you see, I guess, the most activity, right? Or the most, or from multifamily, as far as, different parts of the country or, places that are still moving or not?
Well, we're seeing wherever we saw a huge migration from migration, like New York, you saw a lot of, and California, you saw a lot of migration to Florida and to Texas, right? So, and it's not just in Florida in particular, it's not retirees. They're young families people starting their careers, moving their families down there, and they have a housing need. And their population levels have really exploded and continue to increase. So those areas we're supporting, especially we do a lot on Florida. We don't lend in Texas. Actually, we do Dallas. We've actually moved into Dallas, and we see a lot of opportunity there as well. But we're seeing in the areas where the politics are right, and the income taxes are correct for much more take-home pay for for people. We've seen that population migration, and therefore they need a lot more needs in those areas.
Yeah, no, that's helpful. Think through that. Yeah, where people are going. Obviously, they need more housing, and like you said, there's definitely a shortage. Earlier you mentioned, you all having an aggressive conservative perspective, and I appreciate that. Even just saying it like that as well. I just think, as a buyer comes to you, what's helpful for them to know as far as exactly what you're looking for? Because I think we should have the same perspective, right? As a buyer, can you elaborate just on what that means even more so buyers understand as they're looking at deals?
So as they're looking at a deal, first they should be prepared. We want to know what's your business plan, what's your plan? And we're going to do a deep dive, as I mentioned before, into the sponsor's experience. We want to know about their management. Are they owner managed? Do they use an outside management company? Do they have proof of concept with similar type of transactions? And we want to see that track record with their proof of concept. Are they building for appreciating real estate rentals, or are they acquiring for appreciating real estate rentals, or are they acquiring based on a slight increase, and do the deals pencil out at those numbers at today's interest rate? So we look at all those factors overall. It's just not the asset and the cash flow itself, right? Because you could have a really great asset with great cash flow, and you can have a sponsor come in and muck that up, right? They just mismanage. They don't understand what they're doing, and they've taken a piece of gold and they've turned it into dust. So you can, as a lender, we take a look at the whole gamut. So, what I've been telling everybody today is when I look at a multifamily deal, if a multifamily deal pencils today at today's interest rates, at today's increased insurance rates, at today's, adding a little more extra CapEx because there's always something unknown. If a deal pencils today from a cash flow perspective, without looking for, I'm going to re-rent those apartments at 20, 30% more, and the sponsor has that track record, that proven experience, has his management team either internally or externally in place, that's a deal I want to lend to. Because interest rates will come down over time, may not come down to 2 or 3%, but may come down over time in the next 2 years, 2 3 years, 200 basis points, and they refinance, it's only going to become a stronger asset. We love those type of deals.
No, that makes sense, man. Does it work today? Does it cash flow? That's less risk, right? Correct. We're not counting on, interest rates coming down in the next 6 months, or, getting a refi, right? Sooner than it might happen. What about those that haven't done a deal like that before? Everybody's like, well, Whitney, how do I get started, right? And it's not so much the how you get started conversation, but how do you get the debt? If you haven't done that type of deal before, what does that look like? I'm sure you have people approach you all the time that that maybe don't have that proof of concept, right, or done it before type of asset, under their belt.
So, Whitney, that's a phenomenal question. So, because I've been lending for such a long time, people always come to me and say, how do I get into it? Wow, it looks like, real estate, it, builds generational wealth, or I make so much money if I sell that asset. Everything looks easy when you're the outsider, right? Or it's a crazy story. I have a friend of mine who works in a clothing store, and the guy that owns it decided to syndicate a deal. Multifamily guy had no multifamily experience before. He's going to syndicate a deal in North Carolina with his son, and comes to the people that works for him to put money in the deal. It's bizarre. And this woman had money from inheritance, and I said I wouldn't do a deal like that. First, I wouldn't do a deal unless someone had deep experience. And sure enough, she invested in the deal. And she doesn't really talk much about how it's doing, because I'm not really, we'll just leave it at that. So we also have investors or borrowers, we call them investors, but borrowers who we lend to they buy 1 to 4 family. They start out their career and 1 to 4 family fix and flip. Now, these are not people that are sitting home watching HDTV. These are, that's my worst nightmare. So these are people that started out, they buy a house, they fix and flip, they do 2, they do 10, they do 20. We have borrowers that have done 50, 100 deals. And then then they say, I want to move up to do a bigger deal. They take a 2-family, they make it into a 6-unit, or they convert to a condominium. And then they'll say, it's just as easy to do a 6-unit. Let me do a 20-unit, a 14-unit, a 25-unit. And they build their experience very methodically and very carefully, getting their experience under their belt asset by asset. They didn't go out and buy, a 100-unit multifamily building. We like those borrowers because they've learned very carefully if we support them. And some of those borrowers that we've supported are doing tremendous multifamily owners today, nationally. Some just are more geographic to a certain area. And that's a great borrower. They've learned the hard way. They understand every asset of operating, building, acquiring. They've gone through the pitfalls. Even for myself, just on a little sideline, when the whole residential mortgage industry imploded in 2007, 2008, I started my career on the resi side. And when the world imploded, I kind of sat aside for a while and started buying 1 to 4 family homes in Brooklyn, Bronx, and Queens in New York, and to fix and flip. There weren't a lot of women doing it. I was probably the only one. And I bought over a year and a half, about 50 houses. Well, let me tell you something. One of my houses was my biggest education. Everything that could happen to it happened. I had the wrong contractor. I didn't have one wrong contractor. I had 2 wrong contractors. I had a deal to sell the house that fell apart. And it was really my education. And by the time of that one piece that really was my education, I never had a problem with any of my properties again. It was great. I learned tremendously about how to acquire, how to manage construction, how to build the right team, how to flip the property. It was really a great experience. So it goes the same on the multifamily side, right? I don't want to lend to somebody who's owns a pharmacy. We see this a lot. They own a pharmacy, and they don't own the real estate that pharmacy's in. They're actually renting, so they don't own the building. And now they have cash and they want a multifamily property, and they go out and they buy it. They have no idea how to manage it. Somebody told them it's a great idea, and they fail at it. It ends up costing them more money. They don't know how to do the repairs. They don't know how to do the CapEx on it. They don't know how to handle the rents. God forbid somebody doesn't pay and it's in a judicial state. They don't understand what it takes to evict somebody. So if you're in a judicial state, your tenant's almost your partner, right? So they don't have that knowledge. If somebody wants to come in, the best thing is to partner with somebody who has experience, but really partner with them. You both should have, cash in the deal. Don't just bring a partner in if he doesn't have any skin in the game, so to speak, or she doesn't have any skin in the game. You both want to be investors in that deal, and you want to bring your expertise to the table. If their expertise is they have the multifamily and the management, and your expertise is that you have the cash, know what you bring to the table and pick the right partner. And also pick that if the partnership doesn't work, make sure in that agreement, in your operating agreement, make sure you have a good divorce clause in that operating agreement. So make sure you have great representation when you're entering into a situation like that.
Very wise counsel. Definitely very experienced counsel. No doubt about it. I couldn't not agree more with all of that, especially finding a partner more experienced and having that strong divorce clause, because unfortunately it happens more times than not, I feel like, in a lot of business ventures, right? That it doesn't work out for one reason or another. But yeah, and that's done ahead of time, right? When right. Everything seems rosy, right? Before those times happen. But if you don't have experience, you need to find somebody that does. And I can say that in numerous respects to commercial real estate, where I didn't feel like I had the experience, and we found people, right, to be on the team and partner with us, and that did have the years of experience in that area that I did not. Well, Marcia, we're going to end this segment here. I'm grateful for your time today, and I want the listeners to know we're going to come back tomorrow with another segment. With Marcia, we're going to continue the conversation. We're also going to dive into what contributed to 40% growth at Bayport Funding since she's been CEO. So I'm looking forward to that conversation for sure. Marcia, how can the listeners get in touch with you and learn more about you?
So a great way to get in touch with me is through our website at bayportfunding.com, or to call me at area code 516-441-5888. 516-441-5888. I know a telephone sounds like old fashioned, but we'd like to talk to everybody. Or you can email me at Marcia at bayportfunding.com. And Marcia is Marcia at bayportfunding.com.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.